Great. I think we can start then. So hi everyone, and welcome to our webinar, Metrics That Matter. I'm Fred, founder and CEO of Scoro, and we put this webinar together with Marcel to talk about agency profitability. I'm really excited to introduce Marcel Petitpas, the CEO and co-founder of Parakeeto. Parakeeto is a company that helps agencies measure and improve their profitability by streamlining their operations and reporting systems. Marcel realized that this is actually a huge challenge while running his own agency. Marcel is also the head strategic coach at SaaS Academy by Dan Martell, the #1 coaching program for B2B SaaS businesses in the world. And Marcel and Parakeeto are specializing in agency profitability optimization. He's helped hundreds of agencies around the world measure the right metrics, improve their operations and profitability through consulting them. The same applies to us at Scoro. We're also helping thousands of agencies, consultancies, and other companies around the world for the same reason with our work management platform. Whereas our tools are different, we share a very similar view on what it takes to be successful and run a profitable business. But before I hand it over to Marcel to do the heavy lifting for today, I just wanted to highlight a couple of things. So feel free to add questions in the Q&A section. I will respond to them at the end of the webinar. We are recording and we'll share the recording right after the webinar, probably in a couple of days. But Marcel, I hope you're ready. But before I give it over to you, in your bio, you mentioned that you're eating breakfast foods for every meal of the day. How come, and what's your favorite breakfast? I hope you've had breakfast today, by the way.
Yeah, you know what's so ironic about this is I do intermittent fasting, so I don't eat until like 11 o'clock every day. So breakfast is like the meal that I skip every day, but that's part of the reason why I'll be very often having eggs and toast for lunch or for dinner. And I'm kind of a sweet and savory kind of guy. So if I can get like a waffle, but I can also get like a nice piece of rye toast with an egg on it, maybe some poachies, I'm a happy guy. So I like to mix it up with a full-fledged breakfast.
Okay, I hope everybody has had their breakfast. So, without further ado, over to you, Marcel.
All right, I dropped my pencil, but I'm back. Hi, everyone. And thank you, Fred, and the whole team over at Scoro for having me. It's really exciting to get to collaborate with a platform and a company like yours that has been in the space since before I got into it, helping people manage their work, track time, get a lot of the data together that we need to use in order to get insight into the business. So as you mentioned, Fred, my focus is on helping agencies measure and improve their profitability. And today we're going to be focused on really understanding the 20% of information that you need to know in order to get 80% of the insight into your agency, and hopefully doing it in such a way that does not require you to deal with very cumbersome or very slow to get data. And when I talk about this, I mean primarily your financial data. I think one of the challenges that we faced as an industry is that things have changed a lot in the last 20 or 30 years. The pressure on margin has gotten higher. The complexity of running a service business has gotten higher, and smaller firms than ever have much more complex business models than ever before. There's a lot more complexity at the pricing model level. We're taking on a lot more risk doing things like flat rate pricing, retainers, value-based pricing, and all these different variations. Whereas 10, 20 years ago, everybody just billed by the hour, which, of course, there's all kinds of challenges that can come with that, but it is a lot simpler operationally and from a financial management perspective. And the talent market was very different at that time as well. And so there's a lot of complexity that we have to deal with as agencies. Our business has changed, but the way that we measure our business has not. We still think primarily about financials when we think about measuring the agency's performance. And of course, you got to have financials, you got to do accounting because you don't want to go to jail, you got to file your taxes, but it's one of the least efficient and least insightful sets of data that we have access to as a company to make strategic decisions and understand what's happening. And yet we are often hyper-focused on the finance department as it relates to these questions. So what I'm hoping to illuminate today are some ways to decouple our ability to get insight into the business from financial data, which is often slow, retroactive and unnecessarily precise, and the constraints that are applied to finance slow the pace of our insight in every other area of the business to whatever the pace of that data is. And it makes it such that we're not being able to see anything until it's too late. And so we want to think about creating healthy separation between the financial reporting system, which is meant to do a different job, and our operations reporting system, which is related but intentionally disconnected, and talk about some simple ways to measure those things. So before I get into it, because I'm going to rant, I want to just recap. As Fred mentioned, I run a firm called Parakeeto, and this is what we do. We help agencies install the systems to measure and improve their profitability. I'm also the host of the Agency Profit Podcast. You'll never guess what we talk about on the show. If you're a listener to the show, thank you for tuning in. We always appreciate that. And I also get to apply this knowledge a little bit deeper with Goldfront and with SaaS Academy, where I'm in a little bit deeper as fractional COO and head strategic coach. So here's the deal. Okay. If you're on this webinar and you've got one of these three problems, then you're in the right place. Number one, if you don't really have a clear vision or strategy for how you're going to measure your agency's performance, if right now all you're really paying attention to is financial information, your profit and loss statement, your balance sheet, stuff that your accountant or your finance department is getting you, and when it comes to things like measuring the individual performance of a project, doing analysis on different departments, different service types, looking at utilization, forecasting, if those things feel clunky and you're not really clear on how you're going to close those gaps, then you're in the right place. We're going to talk about that. The second issue you might be running into is you know what you need to measure, but when you go to do it, your data is messy. For example, really simple example, you think, okay, I want to know if we spent as much time on this project as we thought we were going to. And when you pull up your timesheet and you compare it to your estimate, everything is named a slightly different thing. The time entries aren't matching up to what the estimate looks like. The formatting is not consistent. And because your data is not pre-configured to answer these questions, you end up having to spend a lot of time, or your team has to spend a lot of time cleaning this data up to get an answer that really should be quick to get. And lastly, because there's friction or there's a lack of clarity with this information, you might find yourself guessing and stressing about really important decisions in the business, things that have to do with your team, with your clients, with their livelihoods. Do we hire this person? Do we fire this person? Can we take this project on? If not, when can we start it? These kinds of really important decisions about the business should be made with data, but often the data is not available in time for when we need it. So if these are the things that you're feeling, I'm so used to asking people to tell me in the chat, but maybe we'll just flood the Q&A. Type something in the Q&A, a yes, a fire emoji, something. I want to know if I'm on track here. And if these are not the things that you're dealing with, then you should take an hour of your time back. Go have a snack, go eat some breakfast foods, perhaps. It's a good way to deploy that time. So here's my promise today. We're going to talk about some clear metrics and benchmarks that you can measure. Thank you, Matthew. We're going to talk about some frameworks for repeatable outcomes, and ideally give you a system that you can use with your team to create alignment and predictability that doesn't require you to do full open book management in order to empower your team with data. This is another one of the challenges that we run into when we're unnecessarily coupling our operations reporting to finance, is that in order to start exposing information to our team, it requires us to start opening up all of the sensitive information in the company. And that can be a really big lift and propose a lot of risks. And often as founders, we're not even necessarily confident in our financial data enough to start exposing it to the team and having them poke holes in it. So we're going to talk about how to use these simpler metrics to start really empowering your team with data in a way that doesn't require you to jump all the way off the cliff and go to open book management. So here's where we're going to start. We're going to start with core financials, because we want to understand at the end of the day, right? This is about being profitable, and we're going to see that reflected on our financials. So we're going to talk about what needs to be true about our financials, what the outcome is that we're trying to drive towards. Then we're going to talk about margin levers, right? The operational levers that we can pay attention to drive our profitability and ultimately predict how profitable we're going to be on the P&L before we ever get that report. And we won't spend as much time on this today, but the last element here is scoping accuracy, which is about really installing the feedback loops that help us understand, are the assumptions we make about client work and about our team, are they accurate? Because when you really think about agency operations, it's a function of taking our assumptions about our people and about our projects and trying to project them into the future. And if those assumptions are not accurate, then we're not going to have a very stable foundation for operations. And so we need to find ways to close those gaps. And a lot of times, getting data on where the gaps exist is a really effective way to start focusing our energy on reconciling those things so that we can make more accurate projections and we can scale our operations effectively. So let's start with core financials. I just spent the whole first half of this thing talking about why financials are bad, but the reality is everyone's doing them. And the reason I start with this is because this will always be the source of truth about what happened in the past. It'll be the most precise source of truth for that. And everyone's going to do it. And most of you are already spending time and money on this. So I want to share what you should be able to glean easily from your financials and ultimately what the objectives are. So of course, on your financial statements, your P&L, every month, you should be able to track your revenue. If you don't know how much money comes into the business, then you have a problem and you probably need to go talk to your accounting team about this. The next thing that you need to be able to isolate, however, that a lot of folks may not be able to see or is not being calculated properly is your AGI. This stands for Agency Gross Income. Gross income. Okay. So what is the difference between AGI and revenue? Well, what we need to do is isolate what we call pass-through expenses in order to get from revenue to AGI. So what is a pass-through expense? Well, a pass-through expense is essentially a cost that is passing through you onto an external vendor that you're not responsible for the profitability of. So examples of this would be things like advertising spend, materials, print budgets, white label partners, outsource vendors that you're bringing into a project. You want to subtract this from your revenue and isolate it, because if we include all of that, then we have an inflated sense of what our revenue actually is as a company. And it's going to throw off the calculations for our profitability and our efficiency. What we really want to make sure we are able to isolate is how much of the money that comes into the business is our responsibility to earn with our time and with our money. And so this is why it's really important that we isolate pass-through expenses. Now, most profit and loss statements, if you pull up yours, I'm willing to bet if you are doing this, it's happening in the cost of goods sold section on your profit and loss statement. So what that means is the line that says gross profit on your P&L is not actually your gross profit. What it's telling you is what your agency gross income is. So what we actually want to make sure that we're doing next is understand our delivery profit. Now, you might be thinking, isn't that just gross profit? Is that the same thing? Well, it technically is, right? Delivery profit and gross profit should be the same thing. What we're trying to understand is what is our gross profit on our services, or what is our delivery profit on our services? In order to do that, we need to isolate our delivery costs. But I'm using different language. I'm calling it delivery profit because I'm tired of arguing with accountants about semantics and arguing about, is this COGS? Is this not COGS? Because none of that really matters. At the end of the day, what we need to be able to isolate is what did it cost us to complete the work that we were paid for? What did it cost us to deliver on the promise that we made to the client? And so we do that by isolating delivery costs. This is going to be the amount of payroll. The largest portion of this is going to be the amount of payroll that is allocated towards people on your team whose primary job is to do work for clients. This is going to be people like designers, copywriters, developers, project managers, etc. And it might be a part of your salary. It might be a portion of other executives on your team's salary. But we want to do salary allocations to understand how much of the salaries that we spend on every month or every quarter, every year go towards delivery. And then we also want to capture what I call shared delivery expenses. These are going to be things like software licenses, materials, equipment that are not specifically for one client, that can't be attributed cleanly to one or two clients, but that your team needs in order to do their job. It's like a tool that they bring to the job. So examples of this would be subscriptions to Figma, Adobe Creative Cloud, ad management tools, right? These are tools in your team's toolbox. And so the goal here is to keep your delivery costs under 50% of agency gross income, under 50% of agency gross income, so that you can have a delivery margin of 50% or higher. Okay. And this is really the most important metric for you to measure on your profit and loss statement. But most folks listening to this right now, based on my experience auditing a lot of agency financials, can't actually measure this because there's a really good chance all your payroll is just lumped into one big line, one big account on your profit and loss statement, and all of your software is probably lumped into one big thing as well. So in order to figure this out, you'd have to go in, allocate a certain percentage of that payroll to delivery. You'd have to split out your software expenses. So this is a critically important thing to reconcile and to be able to isolate, is what is it costing us to actually deliver our work, so that we know how much of every dollar a client pays us do we actually end up being able to retain, so that we can then pay for overhead and have a profit. So that's the next area to isolate, is what are we spending on overhead? And overhead is generally going to be broken down into 3 subcategories: administration, which is generally going to be anywhere from 8 to 12% of our agency gross income; sales and marketing, which is generally another 8 to 14%. And then we have facilities, if you have them. Not everybody does. We don't, for example, at Parakeeto, we have expenses that go into this category, but we don't have an office per se. We're a remote company. And the important thing here is to try and keep admin or overhead, to 20 to 30% in total. The split of where that money is going is not nearly as important as trying to keep overhead within that range. So what that allows you to do is have a 20 to 30% profit left over at the end of the day. Okay. So here's the big insight. The big thing that no one is talking about. When I get on a call with an agency owner who's struggling with profitability, usually they're only able to really understand their profitability by looking at their financials. And they can usually see this. They can sometimes see this, how much of their revenue is actually there as AGI. And they can usually see this. But what they can't understand most of the time, or what they can't measure, is what's happening in the middle. Why is there less profit here than they expect, even though often there's plenty of revenue coming in on this side? And their focus tends to be on overhead, thinking about how do we cut our costs. But the reality is, if you look at this, there's really only maybe 10% of upside in cutting overhead costs. And it's not a very fun way to get more profitable. Where all the leverage is right here in figuring out how to improve your delivery margin. And a lot of times this will fix any overhead cost spending problems, because as your agency gross income goes up, the relative impact that your overhead spending has goes down. And so this is the thing that almost no one is measuring, almost no one's talking about, but is the single most important and most impactful way to improve your profitability. So I want to spend our conversation today talking about how to increase your delivery profit and really fix the relationship between how much you take in from a client and how much it costs you to deliver that. And by fixing that, that is the fundamental foundation for profitability. If we don't have strong delivery profit, if we're not closing in on that 50% plus delivery margin on the P&L, it's going to be extremely hard to run a profitable agency. But if we are achieving that, everything gets easier. So that's the call to action for today, the thing that we're going to talk about. So hopefully that's tracking with everybody so far. Again, I feel like I want to ask you to tell me something in the chat, but I'm not going to do that. But I am going to encourage everyone, if you have questions so far, let us know in the Q&A so that I can make sure to address those as we get to the end. So let's talk about this. First of all, what is the formula for delivery margin? Okay, in really simple terms. And the formula is very simple. It's agency gross income minus delivery cost divided by agency gross income. Okay, so as an example, if we collected $1 million, we spent $400,000 on delivery costs, then we had, in this case, pop quiz, 60% delivery margin. Okay. And so if we think about this formula, agency gross income has to do with how much revenue we're generating, and delivery costs has to do with what it costs us to earn that revenue. So there are essentially 3 ways to improve this relationship. 3 ways. And yes, I can make sure that there's a copy of these slides available after the fact. Creative Sponge. All right. So the 3 ways to do this, 3 ways to improve this relationship are: number 1, by focusing on average cost per hour. Okay. So average cost per hour, this is essentially a leading indicator and a proxy for delivery cost. So when we talk about average cost per hour, really what we're thinking about is how much does labor cost on a per unit basis, right? So on average, for every hour that we spend doing work for clients, how much does that cost? The formula for average cost per hour is very straightforward. Essentially, what we're going to be looking at is for whatever subsection we're paying attention to, whatever time period or whatever group, what is the payroll for that group, whether it's an individual producer, it's a team of people over a specific period of time. And we divide that by their total capacity over that period of time. And that will give us a sense of what their average cost per hour is. And the basic idea here is that if we have really expensive people doing all of the work, then the average cost of every hour is going to be higher than if we have inexpensive people doing the work. And so if we look at this example of how we would calculate average cost per hour, and I'll stop to address something in a moment here, but we have a strategist that costs $120,000 per year. Their average cost per hour is $57.69. We have an intern that costs less than half. Their average cost per hour is $26.44. And combined, if they split all of the work, the combined average cost per hour is $42.06. So in this instance, if we were targeting, let's say, a 70% delivery margin on a per hour basis, the target average billable rate that we would have to hit is significantly higher if we have a strategist doing all the work than if we have an intern doing all the work. And in combination, we land at about $140 per hour. So this is a really important thing to pay attention to, is if we're finding it hard or not possible to get our average billable rate up high enough to be able to just afford the best possible talent all the time, then what we want to focus on is trying to decrease the average cost per hour. And we do that by trying to essentially have more and more of the work done by less expensive people. And the way we typically do that is by developing better processes, better systems, enabling technology, using templates, providing essentially more guides and more rigidity to our process so that it requires less judgment to get an outcome to a client. Less judgment typically requires less experience. Less experience typically correlates with a lower cost. And so as we mature service offerings, we mature our process, generally what we're able to do is have more and more of our delivery team be made up of more junior employees, and have the senior employees have more leverage and work on higher impact things. And in aggregate, what we're able to do is drive down our average cost per hour, which either lowers the required average billable rate or just starts to increase the spread. So that's at a high level, the simple but not necessarily easy tactic behind average cost per hour, which is really about finding a way to decrease our delivery costs. And so if you're using freelancers, obviously you're going to feel this right away. Your average cost per hour goes down. You're going to feel that profitability increase immediately. If you're using salary teams, you're going to feel this on a bit of a lag, because what this is going to impact is the aggregate delivery cost or the aggregate payroll for your delivery team over a longer time horizon. So if you think about if everybody on our team was really senior and we doubled the size of the team, our payroll costs would be very high relative to if we found a way to get half of the work done by more junior people and then double the size of the team, we would have a materially lower delivery cost. So it's simple, but it's not easy. And frankly, this is probably the least interesting way to improve our delivery margin. So what I want to focus on more is the other two ways that are much more exciting of improving delivery margin, that have to do with making the team we already have. Because most of us, we like our team, we like working with senior experienced people, right? So the question that we're more interested in asking is, well, how do we get more out of them? How do we get that team to be high performing and produce more revenue with the time that they already have? And so there's two ways to do that. The first one is by focusing on average billable rate. And so average billable rate is looking at how much do we earn for every hour that our team spends working on client projects. And the formula for this is also pretty straightforward. We're taking our agency gross income and we're dividing it by delivery hours. Now you notice I'm using the language delivery hours here and not billable hours. This delivery hour might be the same as a billable hour for you, but I'm careful not to use the same language, because if you do actually bill clients by the hour, this might be different. If you bill by the hour, you probably have some instances where it actually took you 120 hours to get the project done, but you only billed the client for 100 of those hours because something got messed up. The client was upset. You didn't want to piss them off. So you only billed them for 100 instead of the 120. So in that instance, you had 100 billable hours, but it actually took you 120 to get the thing done. So your delivery hour value in this case would be 120. This is why I use very specific language, because we have to base our average billable rate calculation on the amount of time that it took us to get the work done, not the amount of time that we billed the client for. The amount of time that we billed the client is irrelevant in this situation. So with that understanding in mind, you can see that this metric can be used to measure just about any subsection of the business. We could look at a week, a month, a quarter, a year, and we could look at everything from a single client or project all the way up to a group of clients, an entire department, or the whole agency. We can use this metric to very quickly and very easily start to get insight into where we're earning revenue efficiently or less efficiently across all kinds of different areas of the business, as long as we're able to isolate these two really simple inputs. How much money did we get paid, and how much of it belonged to us, and how much time did we spend? And so here's an example of how you might run a report like this. And in this case, we're comparing a couple of different projects to each other. We had a website that, although we had a very high revenue and AGI on it, we spent a lot of time. And so our average billable rate for every hour we spent working on this website project, we created $100 worth of value for the business. We had a brand design project that was right in the middle. And then we had this sleeper here, which was the funnel build, where we actually gave 2/3 of the revenue to an outsourced partner. So we only hung on to $10,000, but look how efficiently we earned that revenue. We only spent 50 hours doing it. And so we spent half as much time relative to the website build to earn $1. Or in other words, we earned twice as much money for every hour that we spent. And in aggregate, we had an average billable rate of $115. So imagine sitting down with your team every week or every 2 weeks and looking at a report like this and starting to ask questions like, hey, great job on the funnel build. What can we learn from this that we might be able to apply to our other projects? Are there opportunities for us to spend more time doing funnel builds? And similarly with the website, what can we learn from this? Was there something that happened that we didn't expect? Is there something about our process that might be causing this to take longer than it should? And it can really start to focus conversations about improving efficiency around specific areas of the business where there are clearly opportunity. So again, average billable rate, a really simple and cost-effective way to start getting an understanding of what's happening in the business. And here's a little hack for you. If you remember the formula for delivery margin, right? It was AGI minus delivery cost divided by AGI. Well, if you have an understanding of your average cost per hour and you have an understanding of your average billable rate, you can use those two values as a proxy for the delivery margin formula. So you can start to estimate your delivery margin, again, for any area of the business for which you can isolate those two things. So it's a really inexpensive and fast way to start getting a sense of what's driving delivery margin around the business. Are there specific clients, projects, areas that we need to be focused on? So that's average billable rate. We got one last lever to talk about. Can anyone guess what it is? It's a metric you've surely heard about. I like to call it the dark saber of agency metrics. It comes with great power, but also great responsibility, and used improperly can cause great harm in your agency and to your team. It's utilization, the infamous utilization rate. So let's talk about utilization. This is another way to, again, increase the amount of revenue that your team is able to generate without changing their cost structure. And so utilization, very simply, is asking the question of all of the capacity that we have, how much of it is being used to generate revenue or to move revenue from the balance sheet to the profit and loss statement. And the formula for this, again, is very simple. We look at the capacity for any given team for any given time period, and we divide that by the number of delivery hours worked. And actually, that's incorrect. We take the number of delivery hours worked in a given time period, and we divide that by capacity. And that gives us our utilization rate for any given period of time, again, for any given section of the business. So how much time did we spend earning revenue? And what was the amount of capacity that we had available to us? So if we think about this for a moment, if we're taking our delivery hours and we're dividing by capacity, what are the two different ways of addressing a gap in utilization. So if we're looking at our forecasts and we can see here, okay, we have a certain amount of capacity. We only have this many delivery hours planned. And we have a target utilization that's here, right? So we have an issue. We have a gap. We're not going to have enough hours to meet our target. What do we do in this situation? There are really only two things that we can do in order to close this gap. Noemi, we are going to come back to your question. It is a wonderful question. We are going to get into it because this is where a lot of the confusion lies, right? What exactly is someone's capacity? So we'll come back to that question in a moment. But in this instance, assuming that we're going to miss our utilization target, there's only two things that we can do. The first is we can sell more work, right? Sell more hours, and that will increase the delivery hours and hopefully close the gap towards this target. Now, there's a really important nuance here. We need to sell more work. The mistake that I've seen so many agencies make is they start to expose utilization to their team as a performance metric. And then as soon as it starts to look like we're going to miss our utilization target, what does the team do? Well, they just spend more time doing the same work they had to do before. And that doesn't actually improve our profitability, because if we come back to average billable rate, if we remember the formula for average billable rate, we're just going to spend more delivery hours earning the same agency gross income. So our utilization goes up, but our average billable rate will go down in the same proportion, and our profitability will not improve at all. And so spending more time does not help us improve our profitability unless that time is actually generating more revenue for the business. So we have to sell more work specifically, not just spend more time. That will not help us. The other option that we have is to lower capacity, which is just a fancy way to say we have to lay people off, which nobody ever wants to do. We want to avoid at all cost. But those are essentially the two different levers that we have to pull, is making sure essentially that we're not overstaffed and that we have elasticity in areas that have uncertainty on the team. Essentially, we're using freelancers, contractors, more elastic resources that we don't have to utilize, or that if we do seem like we're going to have a shortage of time, that we go out and try to close those gaps, through new business, through expansion, through taking on Slack projects, through finding opportunities to do additional work for clients and billing them for it. But these are the two levers that we have to improve utilization. So here's an example of how we would run a utilization report. And then we'll come back to your question, Noemi, because it's a really good one. So in this example, we have Brett. He's got 160 hours of capacity. This is going to start to answer that question. Janine has 160 hours of capacity, and Rochelle works part-time. So she had 80 hours of capacity. You can see how many delivery hours they worked, and then that outputs the calculation of what their utilization rate was, and it gives us a total for the entire agency. I'm going to talk about benchmarks here in a second, but before I do that, I want to address Noemi's question, which is, what are we using to measure capacity? What's included in someone's capacity and what's not? And the answer is, and I know for the project managers in the room, you're going to have an aneurysm when I say this, you want to measure someone's capacity based on their total capacity. So what we are not subtracting from someone's capacity is non-billable time, paid time off, holidays, anything like that. If I'm a full-time employee in North America, for example, my capacity is 2,080 hours a year. That's 52 weeks per year multiplied by 40 hours per week. And I know what you're thinking, but that's not actually this person's capacity. What about holidays and paid time off and vacation time and non-billable time? So the simple answer here is twofold. Number one, if we come back to the formula, right, delivery hours over capacity, we want to see the cost of that time reflected when we measure utilization. And we want to see the cost of non-billable time. We want to see the cost of time off. So when we're measuring this for the whole agency, that also means that we leave everybody in capacity, including people that never do any work for clients. Your salesperson, your custodial services person, the founder, all of them need to be included in the baseline for capacity when we measure this on an agency-wide level, because we need to see the cost of that capacity reflected in utilization. The other thing that I'll ask you to think about is, well, if we start subtracting those things out from capacity, then what that means is, based on the definition of that metric and the definition of capacity, the more time off, the more holidays, the more non-billable time that our team spends, the higher our utilization will be. We know that that's the opposite of the truth. And so we can't measure utilization in that way. If we want to measure utilization in that way, we need to call it something different because it's serving a different purpose. That's asking the question, of how effectively are we, utilizing our available resources. It's more of a project management measurement. But if we're thinking about this as a performance metric for profitability, we have to think about capacity as all of the time that was purchased so that we can reflect the cost of those things in here. The other advantage that this gives us is it makes the cost of measuring this significantly lower, because we don't have to track all of those variables down in order to measure this metric every week. All we have to do is model gross capacity and then find delivery hours. Now, the question that's probably still rattling in your mind, Noemi, is, well, where are we factoring that cost in, right? We need to consider it. And the way that we factor that cost in, we'll talk about an example here. It'll all make a little bit more sense. We're factoring that cost into our delivery margin target. Okay, so this delivery margin target that we're setting, we're factoring the cost of paid time off, holidays, et cetera, into this. And when we set our margin target on a per project basis, we're going to set it anywhere from 10 to 20% higher than what we want to achieve on the P&L, so that we can capture the drop off. The drop off for most agencies is going to be anywhere from 10 to 15% for paid time off, holidays, vacation time. And there's a way to calculate this, although I don't have time to get into that today, plus your shared delivery expenses. So in total, generally anywhere from 10 to 20% of your AGI is going to drop off from the project to the P&L level. So the simple idea here is we simplify the metric. It makes it more accurate. It also makes it significantly less expensive to measure. And instead of carrying the complexity of tracking down time off and non-billable hours and making all of these adjustments all the time through the whole reporting system, we just bake those assumptions into our targets for delivery margin on a project and P&L level. And now we factored that cost in, but we've removed the requirement to measure it all over the place. So hopefully that makes sense. Unlimited time off policy, meaning the available capacity for varies per person. How would you create a baseline utilization rate? Yeah, Kristen, you just basically use an average. You make assumptions. So we also have unlimited time off at Parakeeto, but what we know is that people take about 3 weeks. That's the average. So that's what we're going to base our modeling on, is, assuming that people take 3 weeks, maybe you have slightly more, slightly less than that. The nice thing about unlimited time off, and maybe this is how you see it, maybe it's not, but most people that use an unlimited time off policy, their team actually takes less time off compared to companies that offer a specific time off policy. So it's a really great way to do some virtue signaling and appear more progressive than you actually are without actually bearing the cost of that. That was certainly part of the reason it was attractive to me, if we're being completely honest. But it also is a lot less administrative burden. You just kind of trust the team to make sure that they're getting things done and they take time off. So that is how we would think about unlimited time off, is you just kind of have to model how much time do you expect the team to take. That'll get factored into their net utilization target. All right. So let's talk about utilization benchmarks. So keeping what I just talked about in mind, that you're factoring all of the capacity for all non-billable team members and all of the capacity for billable team members into the baseline for utilization. These are the targets. And they're going to seem a lot lower, probably, than the benchmarks that you've heard from your peers in the industry, because most of them are doing one of two things wrong when they measure utilization. They're stripping out their non-billable people. So they're only looking at this on the delivery team level. They're stripping out non-billable time or vacation times or holidays. And a lot of times there's actually a third thing they're doing wrong, which is they're not defining a billable hour properly. Often when they're really focused on utilization, it means they're using it as a performance metric for their team. And as a result, the definition of a billable hour starts to get conflated from things that are, driving revenue for the business to things that are productive. So working on the company website all of a sudden becomes an air quotes billable hour, even though, based on this definition, we know that's not true. And so it starts to inflate their utilization. So when you hear a company say, oh, our utilization rates are 80, 85, 90%, immediately there's a red flag there. There's a really good chance that they're not calculating it in the same way. So with that in mind, a pure producer on a weekly basis, assuming, all things are normal, they're in the office for 5 full days, you've got lots of work to do, they're generally going to be 75% plus. So this is 28 to maybe on the really high end, 36 hours a week of billable time. And what's generally going to determine their level of utilization is their client dilution. If you have a software developer that's working full time on one project for 8 months at a time. They're 100% allocated to that. It's not unusual for them to be 95% utilized and not be stressed or burnt out, because there's very little other things they have to worry about. There's very little context switching. Whereas if you have an account manager that's jumping around between 25 different clients, their utilization might be 65% and they're going to feel extremely stressed. So the amount of client dilution that you have on your team is often going to modulate what is a reasonable amount of utilization that you can expect from them while them still maintaining their sanity. Then delivery managers, these are going to be people like, the director of engineering, the senior design person, that their job is really to manage the delivery team and not as much, about spending time on client projects. And when they do, they're usually coming in, doing very high level, very specific things, and then kind of backing out and letting the team do the rest of the work. Anything above 35% really is good for that kind of a role, similar for account managers and project managers, but you're going to see a massive variation in these targets. And then anyone else on the team, right? Your admin assistant, salespeople, et cetera, anything above 0 is a bonus. Ultimately, what you want to generally try to target is an agency-wide baseline of 65% or higher. And then when you look at this on an annual basis, you generally want to take out anywhere from 10 to 15%, maybe 20% if you have a very generous time off policy, to account for those things. So that means pure producers end up in the 60% plus range, delivery managers in the 20% plus range. But what's important is you generally want to have a baseline of 50% or higher as the agency. So at least half of the time that you're buying from your team, if everyone hit their targets, you should be able to get up over 50%. Now, I'll say a caveat on this. This can be lower. This gets into the 4-hour work week conversation and unlimited paid time off. You could have a agency-wide utilization target of 40 or 30% and still be profitable. The question is going to be who's paying for that. And there's really only 2 ways to pay for it. Either the team gets paid less money or your clients pay for it via a higher average billable rate. So just keep in mind that all 3 of these levers, you can pull on them. There's an infinite number of combinations that can get you to your delivery margin target. So keep that in mind as, if you have a lower agency-wide target or you're modeling your business such that your target is going to be lower, keep in mind that you're just going to have to find a way to finance that. So I want to bring all these things together in a really practical example so you can get a sense of how all of this actually plays out in a real life scenario. And then you can take this and go and run these numbers for yourself. I want you to imagine we have a very small agency. They've got 10,000 hours of capacity. This is about 5 full-time employees. And their delivery cost is, let's call it $300,000. Okay, so that's what it costs them to pay their delivery team payroll and their shared delivery expenses. In the first example, they're utilized at 50% and their average billable rate is $100 per hour. So this team in a given year can earn $500,000 of agency gross income. So that puts their delivery margin at 40%, which is not great, but it's not bad either. They're probably going to have a margin at the end of the day of around 10% in their business. Now, in example number 2, they're able to increase their utilization just a little bit to, let's call it 60%. Okay. They keep their average billable rate the same. Now they're able to generate $600,000 with that same team. That gets them to a 50% delivery margin. So they're doing much better. Lastly, they're able to make some pricing tweaks. They're able to find ways to get more efficient at getting work done for clients. And they're able to get their average billable rate up to $125 an hour. Now they're earning $750,000 with the same team, with the same cost basis. They've now increased their delivery margin to 60%. Now, here's what's interesting is if you think about this, this is a 20% improvement to their delivery margin. It's going to be more than a 20% improvement to their bottom line, assuming that what they were spending on overhead when they were doing $500,000 in AGI is still the same as what they're spending on overhead here. Relatively speaking, it's going to be lower. So this is probably closer to 26% improvement in net profitability. And ultimately, it's an extra $250,000 straight to the bottom line because nothing else has changed. The cost of the team hasn't changed. The cost of running the business hasn't changed. Basically, this team has just increased their ability to generate revenue by becoming slightly more efficient, all by just optimizing these 2 fundamental levers, average billable rate and utilization. So hopefully that gives you a sense of just how powerful these seemingly small and nuanced numbers can be in improving your profitability. So I'm going to stop there. I think that's the core of what I want to cover today, but I do want to share some resources for anyone that wants to go a little bit deeper. If you want to grab some spreadsheets, some templates, watch more training videos that go deeper on this stuff, you can head to parakeeto.com/toolkit. And there are actually some worksheets in there that allow you to punch in your whole team, figure out what your utilization targets should be, figure out how much money you'll make if you increase or decrease your average billable rate. So you can run through a lot of this math on your own. It's all totally free. So feel free to go and grab that. And then we'll open it up for Q&A.
Thank you, Marcel. This was really great. Very, very valuable. So I hope everyone found some actionable nuggets here. Before we proceed to Q&A, just wanted to reiterate that most of what Marcel talked about are the exact reasons why we started Scoro and what keeps us going. So whereas having any system in place, as long as you're tracking the right things, is important, we believe most agencies just use too many tools that don't talk to each other properly, and that causes a lot of these challenges. So our answer to this is our end-to-end approach to managing work. And this allows managers to control the entire business just from one place. And they can monitor in real time all the metrics that matter, plug intended, from revenue, margin, delivery profit, ABR, AGI, delivery hours, everything that Marcel was talking about in his presentation. Also, a key area of focus for us is resource planning and time tracking. I think it's a sensitive subject. I saw we have a question about this as well in our Q&A. So what we do is we really want to help our customers fight these unpredictable workloads. The consistent, constant balancing act of too much or too little work. So tracking billable hours, delivery hours, non-billable hours in real time is key. And most importantly, I want to kind of emphasize that while completing projects, delivering work to customers is important, customers are happy, things get delivered, but are you happy as an agency manager, as an agency owner? That's a different question. So what truly matters is whether your company is making money, and we at Scoro will help you make sure you're profitable. You understand which clients, projects, services, or teams, people are profitable and which aren't. So you can maximize the profitability of your business. And I just wanted to say, feel free to reach out to us. Our consultants have worked with thousands of agencies. They'll be happy to share what we've been seeing and hearing, especially now at these challenging times in the economy, when efficiency, control over costs and margins is just much more important than ever. We also have an extensive blog dedicated to working smarter, not harder. So you're definitely welcome to visit scoro.com. But now, as promised, a little Q&A. You already covered many questions while speaking, Marcel, so kudos on that. But there's one question here from Bradley. How do you recommend the business tracking markup on pass-through costs? You see the question, so.
I do. This is such a good question. All right, I'm going to get on my soapbox a little bit here. So I love this question so much, Bradley, because markup is a perfect example of one of these concepts that we've created as a way to justify a price to a client, but it's completely screwed up our thinking as an agency internally. If you really think about markup, it's not real. And what I mean is it's not real in the sense that it's something separate from the agency gross income of a project. So when we think about putting a price in front of a client, we want to really think about separating two ideas, right? There's price, which is really asking the question of what will the client pay? What will the client pay? And then we have scope, which is really about what will it cost us to do this? And one of the challenges that I see a lot of agencies run into is they're using the same document for pricing and scoping that goes in front of the client and that they use internally in order to set their own expectations about what's happening on a project. But those are two very different stakeholders with very different needs. And often the way you want to talk about a project internally is very different then how you need to finesse that information to put it in front of a client. And markup is one of the ways in which we finesse something that is objective and really has nothing to do with markup. So I'll give you a practical example. Let's say we have a project where the client is paying $20,000. Okay. And in that, we have a $5,000 pass-through cost. And it's going to take us, in this example, 150 hours to do this project. So in this example, our agency gross income is going to be $15,000, right? So it's 20,000 minus the pass-through of 5,000. Okay. And then our average billable rate is going to be 15,000 divided by 150. So what is that? $100 an hour. And let's just say our average cost per hour on this is $30 an hour. So that tells us that our delivery margin is about 70%. Okay. So internally, this is the information that we need. We need to understand, is this thing going to be fundamentally profitable? What's our agency gross income? What's our average billable rate? What's our average cost per hour? And we can arrive at this information, whether we're billing the client a flat rate, a value-based rate, a retainer, we're doing it based on the hour. So how could we communicate this $20,000 price to the client? Well, there's a whole bunch of different ways that we could do that. We could say it's a flat rate of 20K, right? And we don't even tell them there's pass-through expenses or markup happening. We could say it's 15K in agency fee with 5K in pass-through. Or we could say it's a flat rate of 20K, but that includes, let's say, $12,000 in agency fee, 5,000 in pass-through, and 3K in markup. We could say it's 4 sprints at $5,000 per sprint. We could say it's this many hours at $200 an hour. Like, there's so many different ways that we can communicate this $20,000 price to the client, using markup, not using markup, using hours, using flat rates, using sprints. Like, we can finesse this however we want, but this information, this math is always the same no matter what. So I think that is a really, really important thing to consider, because ultimately the only thing that matters to the agency's profitability is what is our AGI, how much time will it take us, and what will it cost us to get that done. And markup, if you really think about it, should only really be considered to the extent that it's covering the additional time that will be required to manage that external vendor. And it doesn't even necessarily need to do that. If all it did was just increase your AGI, then it's still great, right? If you can use markup because it's something that your client expects to justify a price increase, then do that. But hopefully this helps separate like markup as a pricing concept, as a way to represent something to the client, versus what is always true, which is just this simple math internally. So hopefully that answers your question, Bradley, and I appreciate you asking it.
Thank you, Marcel, for that elaborate answer. I think we need to be mindful about time, so we have one final, very quick question. Just one anonymous question. I guess maybe it's easier for us to respond to that in writing. It's on utilization rates, but there's a more interesting one. Just quickly, what are key mistakes agencies make when trying to measure their profitability?
Yeah, there's a lot of them. And I'm going to try not to make this another elaborate answer, but I would say that the biggest one is not measuring delivery margin. First and foremost, they're focused on net profit, and often they're trying to do something like measuring net profit on a per client or per project basis. They're thinking of everything through a financial lens, and they're thinking of everything through a net profit lens. And often what that ends up doing is actually being a far more cumbersome and expensive way to try and get an insight that's actually a lot less accurate. Because when you think about measuring net profit on a project, for example, it's kind of a fundamentally flawed concept, because you have all these factors that are going to influence that number that have nothing to do with the individual project. You know, was your overhead the same as it was on a previous project? Did you have more projects to subsidize that overhead on previous than you do in this period? Was your utilization rate higher or lower? Like, none of these things actually have to do with the fundamental profitability of the work. So I think the biggest mistake, there's lots of them, like we've talked about confusion between billable hours and delivery hours. We've talked about not measuring capacity properly. So we've addressed a lot of them, but fundamentally, it's being too financially focused and thinking far too much about net profit, as opposed to really being observant of delivery margin and making sure that that's healthy, and then thinking of overhead as a separate exercise in managing the business's health.
Great answer. Thank you, Marcel. There are a bunch of questions about how all of this can be done on Scoro, whether from our existing customers or someone considering it. So we will definitely answer all those questions offline, and feel free to reach out, as said, both to Marcel at Parakeeto or us at Scoro. Thanks a lot to everybody who participated, everybody who asked questions, and especially Marcel for delivering this great content. Thank you, and looking forward to another joint webinar, Marcel.
Likewise. Yeah, thanks for having me. This was a real pleasure. And for anyone watching, feel free to reach out anytime. I'm always happy to nerd out. As you can tell, I could talk about this forever.
Thank you.